This is Tim Phillips, Chief Investment Officer at Phillips & Company Advisors. Thank you for taking the time to look at our Q4 2024 look ahead. Please read all the disclosures and footnotes carefully. We're entering a macroeconomic phase that is almost binary. In one direction, recessionary forces could prevail, and in another direction, continued economic expansion could outweigh those forces. With the recent half-point interest rate cut, we're set up to see how this plays out in the next quarter or two. If rate cuts accompany no recession, equity returns generate pretty strong returns in the next 12 to 24 months. That's historically. Alternatively, if rate cuts accompany a recession, we can see some significant negative drawdowns in equity returns in the next year or two. So are we recession bound? That seems to be the critical question. Looking at common recessionary indicators, that can shed a little light on the subject. Unemployment is still very low. Wage growth is now outstripping inflation. That should provide a little relief to the high prices being paid in the economy. Retail sales ticked higher recently, and the current GDP growth forecast of 3% suggests we're not currently in a recession, and although things can change, the trend suggests that Q4 and Q1 2025 don't hold tremendous recessionary forces. However, and again, this is the binary economy we're in, there are signs of economic weakness lurking in the shadows. Manufacturing's in a contraction, consumer confidence, especially about future labor market concerns, are at lows not seen since 2021. We are now seeing credit delinquencies on the rise, and savings at a personal level are now well below long-run averages. We need to keep an eye on these, as these are also early indicators of potential recessionary threats. Before we run for cover, it's always critical to realize, in the long run, corporate earnings matter a lot. To that end, we've seen massive upward revisions to corporate earnings by nearly 300 basis points compared to historic revisions. Earnings per share in Q2 crushed the numbers compared to Q2 2023. And while Q3 looks a little soft when they report, Q4 looks very strong. Overall, 10% earnings per share growth rate for 2024 is very promising for equity returns. It's true that U.S. equity valuations are at high levels, as you can see in the chart on the upper right, but investing at highs has not been terrible for long-run equity returns. The big news is we're now in an interest rate cut cycle that should play out in Q4 and beyond. The Fed's forecasting more rate cuts this coming year, clearly suggesting they're worried about the economic weakness hiding out in the shadows. We should expect another 50 to 70 basis points of cuts in 2024, and the yield curve is finally uninverted and now is normalized between 2 years and 30 years. That positive sloping curve is very normal. That's good news as long as this normalization does not accompany recession. Again, when the yield curve normalizes as it is, with no recession, we see strong equity returns in the coming years. And certainly we see strong bond market returns as well. Developed markets like Japan and Europe are trading at a 34% discount to U.S. equities. However, their growth rate at 3.3% earnings per share growth for full year 2024 is 3 times lower than the U.S. We see slower growth and perhaps the start of some deflationary pressures in developed markets. China will continue to export deflation to these markets from electronic vehicles and also other industrial products. And that's in an effort to prop up China's domestic manufacturing sector. Again, we maintain underweight developed markets and will continue to do so until we see significant changes in consumer demand in developed markets. On the other hand, we see great opportunity in emerging markets. While they're trading at a 44% discount to US valuations, earnings per share is expected to grow at a whopping 23% over last year. India being the most opportunistic, and perhaps some hope from China in the coming year, and we'll talk about that in the next slide. We continue to overweight emerging markets in portfolios. China is in a deflationary cycle. Weak consumer demand, declining home prices, and the only thing working is the manufacturing sector, which is driven by exports, specifically electric vehicles, which are highly subsidized. Being a past investor and current investor in China, we've learned that they'll need a bazooka of policy stimulus, and it's possible they just might have brought that out, perhaps maybe a little too late. The major event for Q4 will be the US presidential election. We've tried to summarize each candidate's stated policies here. While we don't publish our personal private views on politics, we did note the higher corporate tax rates under the Harris administration can be a hit to earnings per share. However, be aware that corporations are notoriously good at recharacterizing their income to the advantage of shareholders, and we would expect no different this time. If you glance over our mean reversion dashboard, you see very few areas between segments, asset classes, and regions that are undervalued. In fact, most everything's overvalued. Things like frontier markets, which are very difficult to invest in, are undervalued. China and Brazil may provide the best opportunities in emerging markets. But again, we're focused in on managing allocations in a difficult, overvalued environment. You can read our views and recommendations here, but high-level summary is this. We think the Fed will continue to cut interest rates as the U.S. economy shows any signs of ongoing weakness. We believe the U.S. consumer overall and on average will continue to show strength in spending and earning. However, that lowest income cohort is starting to show some frailty. We'll have to watch that closely, but I don't believe that one particular cohort's enough to pull down the whole economy. We think we're going to continue to reweight large cap growth and small cap to the benefit of rising earnings and moderating financing costs. Again, we maintain an overweight to emerging markets and take advantage of reasonable earnings growth to valuation prospects. We're now moving duration in fixed income from long to moderate, probably in the middle point of the yield curve with a 6 to 8 year exposure. Thank you for taking the time to view and listen to our Q4 2024 look ahead. If you have any questions at all, you can see my email below. You can see our web link below. And of course, you should reach out to your advisor for recommendations and more thorough advice. Again, we appreciate the opportunity to serve you. Please contact us at any time.